The share prices of most Australian listed infrastructure companies have been very volatile recently. Given the underlying businesses should be inherently stable, this has no doubt surprised many investors. Listed infrastructure companies in Australia, however, tend to be quite different from their overseas counterparts. Of the 10 listed companies in Australia owning power generation and utility assets, 6 are externally managed by investment banks or investment funds. In recent times, a number of these companies have paid out more in management fees than they have earned in profits in those same years. 2 of these companies have actually paid out multi-million-dollar fees despite making losses in those same years. Some of these companies have taken on too much debt to acquire assets and have paid dividends out of increased borrowings rather than operating cash flow. Nucleus' portfolio doesn't currently contain any listed Australian infrastructure companies, as we believe there are better opportunities in overseas markets. If we look to the markets of North America and Europe, which represent the vast majority of the infrastructure sector by market capitalisation, we see the situation is quite different. Let's take the US as an example. Of the utilities and power generation companies listed on the New York Stock Exchange, none are externally managed by an investment bank, and most have been operating under a regulatory regime which has remained broadly unchanged for decades. The purpose of this regulation is not only to ensure these companies don't exploit their monopoly position, but also to ensure they remain profitable enough to provide these services at an acceptable standard. Politicians are only too aware of the damage that repeated blackouts can do to their re-election prospects. In the US, regulators allow utilities and regulated power generation companies to pass through operating costs, interest and tax to customers. They also allow these businesses to earn a return on equity of between 9 and 13%. This eliminates many of the risks that most businesses face and has resulted in the utility sector in the US earning very stable returns over a long period of time. Over the last 15 years, the utility sector has on average earned a return of around 11% per annum and has earned a return of at least 10% in every year. In Europe, utilities operate under a similar regulatory regime with the monopoly characteristics of these businesses and the stable regulatory environment in which they operate has translated into the global utilities sector earning stable returns over a long period of time. Over the last 15 years, the UBS Global Utilities Index has earned a return of 11% per annum compared to 7% for the MSCI, which is the generally accepted benchmark for global equities returns. Furthermore, this return has been generated with less risk of capital loss. It is because of this attractive risk and return profile that presently North American and European utilities form the core of our portfolio.